Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
We had a very sharp bounce this morning, and I have some very strong opinions as to why it happened. So I wanted to kind of go over those first and foremost. So ironically, the title of this was Bounce Before Inauguration, which we came up with, what was it, Monday morning? So obviously we've had the gap down in the election and then the bounce the past Tuesday and Wednesday. Tuesday was quiet. But this morning, many are kind of focused on this teeny tiny little beat in CPI. And I'm going to push back on that strongly, which is to say the detail of the data against this 44-month-long trend in above 3% CPI is not the reason that we had this reflexive bounce today. It's a combination of things, and I want to kind of go over those because I think it really does matter. And it also is very focused on an option trade that I recommended for clients yesterday. So first and foremost, we did have the CPI print out. I did a long review pre-market for clients about why it wasn't so much of a beat. And big picture, we still have very strong trend growth and sticky inflation. But the algos react immediately, even off this tiny little beat pre-market. And we ended up gapping exactly above SPX. Was a line in my sand, which basically we get above 59.05, it's bullish. So basically we gapped down below that level on January 10th. And then 5 days later, here we are, we're back above it. The other reason, which is if you watch hedges, it is a little tricky to do this, especially when they come in last minute. But yesterday, there were a lot of ES futures that were being hedged, so they're buying puts, and it ended up yesterday, this was just yesterday, it ended up driving the put call ratio to like 3:1. So this morning when CPI and algo reaction created this kind of unwind in those puts, that was more fuel for the fire in supporting this bounce today. Yes, Monday it was the election gap down. We all know about that. All eyes were on that prize. That was easy, right? Sometimes when we talked literally about this last Wednesday, sometimes the easiest is actually the most profitable because you just know it's coming and everybody else sees that it's coming, and it came. So we gapped down on Monday, we digested on Tuesday, and then today we had the algos and the hedges, but we also had banks beating. So we had this kind of sentiment relief that banks who that announced this morning with their earnings pre-market kind of relieved the market of the worry of their performance. By the way, they're hiking fees and they're making money off of it, as well as consumer spending. And basically that's a tell on the economy. So recession risk, all that jazz, kind of gets pushed away if banks are doing well. They're the lenders, so we kind of need them and a rosy print. And we can drill into the bank earnings, but that's not our purpose today. It's the combination of factors that come in to cause this volatility suppression and or drop, and that's exactly what we had. Volatility continued to break down below 1929, and we had markets bid up. But I contend, I know this is 5 points, but I contend that the biggest reason for the season is Bank of Japan. So I had mentioned yesterday that the 10-year JGB was percolating higher. It had pushed from 1.1 all the way up to 1.25. And I said, this is going to make the yen and bonds bounce. This was the number one reason I was looking for. And then yields would come down and dollar would soften. And that combo deal would also support equities, right? And that's exactly what happened. So last night, we had Bank of Japan came in and basically said, hey, UEDA said that they are very seriously considering a rate hike. And this meeting this month, which is the end of January, is live. So that increases the chance, basically the betting market, right? Those who are shorting yen start to cover. And we had a big bounce in yen, which obviously flows over. We got a rate differential that's going on with US and Japan. And that caused a very nice move in bonds. And that was exactly as I warned yesterday. So literally, in my trading room notes, I had put this, which was ignore PPI, ignore CPI. The reason bonds are going to bounce and yields are going to soften is because of yen bouncing, because Bank of Japan is going to pull forward some rate hike talk or action. And that's exactly what happened. So I did have this, and you can also see a TLT February, $85 call, $85 put, bull risk reversal. So selling the put, buying the call for scratch. It wasn't really scratch, it was like a nickel. Well, that's $1.85 right today. So it was extremely good timing to put that on But it wasn't so lucky. I actually was giving this time because I said CPI or Trump or peace, which, by the way, we also got the announcement this afternoon, Hamas, a hostage deal, very likely, et cetera, which also helps soften dollar in yields. And of course, the yen bounce. So the macro reasons are much bigger than the CPI teeny tiny little adjustment that they made. And this is why I wanted to kind of point that out, because last but not least, this was the reason I gave yesterday, reason number 5. So I've given you the CPI algos. The banks did great. Bank of Japan is already intonating a rate hike. And then, of course, the hedges had to unwind. This was the 5th reason. I had posted this yesterday for clients and basically said, hey, this is my dollar yield ratio. This is part of my intermarket wonkiness. I call it my secret sauce. And if this rolls over, this is going to pop up. And it literally popped right here. So it literally popped here and we've been moving higher. I should have put a little trend line here. Anyway, the point is this today, I will show you, is right here. Look at this. Look at that. Head and shoulders dumped right back down. And this was taken earlier, obviously, about this morning, 10 o'clock. We're pushing into this kind of 59.75 SPX territory. I wrote down some other things like 596 for SPY. We already hit 517 for the Qs. Long story short, this was a lot of factors, but mostly the yen and the bonds bouncing, causing yields and dollar to fall. And that TLT bull risk reversal was one way to manifest a bounce. With time, that was a February OPEX dated bull risk reversal that went from 5 cents to 185. So that worked. Now where to?
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.